What I'm going to do today is I'm going to kick it off with discussing options. Okay, options 101. I'll use the example of Coca-Cola as a way to protect your shares. So think of options like it's an insurance contract, kind of like you have insurance on your house or your health in case something goes wrong. And what you can do is if you own a share of Coca-Cola and you want to protect that share, right, in case it goes down, well, you can either sell Coca-Cola shares, or what you can do is you can buy an insurance contract on it. Now, why would you not sell Coca-Cola, ticker KO, if you owned it and you were scared it was going to go down? Well, there's a couple of reasons. Number one, in most countries, you pay less tax if you own something for more than 1 year. Okay, it's called long-term capital gains. Okay. So, and that governments do that in order to try to incentivize citizens to not day trade, because governments hate volatility. And so let's say that you've owned Coca-Cola for less than a year and you made a lot of money on it and you want to sell it yet because you'll pay a lot of taxes. Well, what you can do is you can buy an insurance contract, or what's called a put, which will protect you in case Coca-Cola shares go down. Another reason that investors use options, puts and calls, which I'll explain in a second. Another reason investors do this is because big institutional investors at hedge funds, and when I used to manage a lot of money at hedge funds, what I would do is at the end of every quarter, I would want to sell certain stocks, but I didn't want competing hedge funds to know that I sold them or started to sell them. And maybe I didn't want investor relations from big companies that recently went public to know that I didn't sell their shares, for example. So you can buy insurance, which is called a put. Okay, so a put is like a protective coat that will protect this in case it goes down. So if the shares in Coke go down, then the value of the put goes up and you don't lose any money. And there's tons of different types of options contracts I'll explain really quickly today as well. Now, a put, the most you can lose is the amount you paid for this put. Okay, it's a small amount you pay, and and it expires on a certain date as well. Usually expires worthless unless it's in the money, which I'll talk about in a second. Okay, so I describe what puts are. Let me explain quickly what calls are, and then we'll look at plenty of examples as well. And if you have certain examples of options you want me to look at and analyze for you, please let me know here in real time, and I'll humbly help you out. So a call is the opposite of a put. A call basically means you pay a small amount of money, and for a limited amount of time, if a stock goes up a lot, you can make a fortune, right? You can make 100 times this amount if the stock goes through the roof, which is rare but happens with biotech stocks. So let me show you how to value a put and a call, and then I'll show you some real examples. And if you guys have examples of real puts or calls or that you want me to value for any stock, let me know and I'll do it. All right, so when you create an option, it's not like just buying a stock. Like when you buy a stock, you just buy it and it goes up, you make money, goes down, you lose money unless you're short. When you buy a put, there's a bunch of different variables and calls, okay? One is it a call or is it a put, which is self-explanatory. Then you have to look at what's called the expiration date, okay? Now, and I'll get this in focus here, yeah. The expiration dates. So what happens is these puts or calls, they're only valid and they're only worth something for a certain amount of time. Kind of like an insurance contract. Like if you get life insurance or insurance on your house, property insurance, it only lasts a certain amount of time, then you have to renew it. It's the same thing with options as well. There's an expiration date. Okay. And options usually expire on Fridays, unless Friday is a holiday, in which case it might be a Thursday. And I'll show you plenty of examples in a minute. Okay. The next thing you look at is volatility. And this one is crucial. So if a stock is very volatile, meaning it goes up and down a lot more than other stocks, then it's going to cost you a lot more money to buy an insurance contract on that, meaning a put or a call. Similarly, when it comes to health insurance, if you're in really bad shape and your heart beats is really erratic or too fast, whatever, then what happens is the health insurance contract you're going to buy for yourself or life insurance is more expensive. So if a stock moves up and down like crazy, like Tesla, or Netflix, which just reported earnings, both of them. I can talk about those two earnings reports from me too as well. If a stock is very volatile, then the option is going to be more expensive. So that's another ingredient into making this Coca-Cola option. Now, Coca-Cola is not as volatile as other stocks, and so the options are relatively cheap, but the market is expecting what's called implied volatility to go up very soon, which I'll explain with a real example. And again, let me know any stock, and I'll take a look at the option for you. Then the last component we're going to look at, and there's a couple other ones as well, but I'm keeping this simple for me. The last one we're going to look at is the strike price. Okay, now what the strike price is the value at which, a level at which for a put or a call where it's worth money. So let's say that we own Coca-Cola. It's around $56 right now, and we wanted to get protection in case Coke dropped below 50. So we buy a put with a strike price of 50, and if Coke goes below 50, then that option is in the money because it's below the strike price of 50. If it's at 50, it's called at the money. If it's above 50, it's called out of the money. And the same thing with calls. So if Coca-Cola, which is around $56 now, if I bought a call that had a strike price of $60, then as long as I owned that option right before it expires, if the price of Coke goes above $60, meaning the strike price is 60, then you make money. Okay, and of course you have to account for the price of the option as well when calculating that, which I'll show you as well. Now let's go and take a look at Coca-Cola stock, and let's try to price a put or a call on Coke. So let's go together to Yahoo Finance. And by the way, everything I'm teaching you right now is in an options course I have, which is part of my MBA program. And you can go to learn.harounventures.com to learn more about that. Okay, but let's go to Yahoo Finance, okay? And what I'll do is I'll type in the ticker for Coke. Okay, and Coca-Cola right now is trading at 55 and change. So what you do, and this works for most stocks, is you click here on options, okay? Now, if you don't see any data on this page, it means you can't trade options on this particular stock. And usually more liquid stocks you can trade options on. Okay, and I recommend that if you guys are going to transact in options, take my course, my MBA program, whatever, but more importantly, I want you to practice with a paper portfolio for at least 6 months because you can lose more money than you invest. It can be deadly. Buy puts or calls, but never ever underwrite or sell puts and calls. Just buy puts and calls and use a paper portfolio first. Okay, so right here we could see the expiration date, which is one of the components here for Coca-Cola. Okay, so let's select January 19th of 2024, and it's almost always on a Friday. And let's go down and let's look at puts. Okay, and the way to read this is just the ticker. Okay, this is the last trade. This is the strike price, and you got the bid and the ask. Make sure to pay attention to volume and implied volatility, which I'll talk about in a minute. Okay, and implied volatility means what the market is expecting for volatility for a particular stock. So let's go down here to puts for Coca-Cola. Okay, puts that expire. Say I want to get protection for, I don't know, a year or two. That expire on Friday, January 19, 2024. And let's look here at the 50 strike price. Okay. Now, the way to value these things is I have a methodology which comes in my complete options course as well as in my MBA degree program. And for those who already registered in the MBA degree program, you never pay for any new stuff I add. And this is added in FA 4.4. That's Finance and Accounting Semester 4, Class 4. Okay, moving on. And so what we're going to do is we're going to look at the volatility of Coca-Cola's stock over the past year. Ideally, you want to look at the past 6 months because Coke has been much more volatile, and the entire market has, in the past 6 months than a year ago, for obvious reasons. The market's going down. All right, so we'll just do it for a year for fun. All right, then what we're going to do is we're going to download the market data for Coca-Cola for the past year. And so I created something here, and there's no macros in this at all, but this is going to download directly from Yahoo Finance a bunch of options data right here. So what we'll do is this is in comma separated value format. We're going to open it with Excel hell as opposed to Keynote. I'm going to copy all this data, and this is just data on Coca-Cola over the past year, just stock data, I mean the stock price. Okay, so let me go back over here now to here. And then what I'll do is I'm going to paste all this data directly into my spreadsheet. Let me override that. Okay, good. All right, great. Now we have the historical data for Coca-Cola. So what's the current stock price of Coke? Coca-Cola stock is $55.21. Great. Okay, so we'll enter in the price, which is one of the inputs here, 55. Whoops. 55, let's try it again. And let me actually move this over, I'm gonna over a bit so you can see below my face, 55.21. Stop doing these things live. Okay, we're gonna select a put, okay, good. Then we're gonna select the strike price. So if Coke goes below 50 bucks, we wanna be protected. We want that insurance policy on Coca-Cola. All right, now what we're gonna do is we're gonna select the expiration date. And as I mentioned earlier, options usually expire on Fridays, okay? So I'm gonna select, let's go down here, make this interesting. Yeah, I'll select January 19th, 2024. Okay, great. Then you put in the interest rate, and interest rates have been going up a lot, and this is the 1-year Treasury rate. You can get it from treasury.gov. And that's basically the risk-free rate. And so the value of options have gone up a lot because interest rates have risen recently as well. It's one of the inputs. Okay, and then we're gonna go down here and we're gonna look here at volatility. So volatility right here, this is how volatile the stock was in the past year. Okay, this here is called the historical volatility. And the implied volatility is much higher, and I'll explain that in a minute. And if you take the course, you can read through all this to find out the probability where Coke stock is gonna be in the next, 1 or 2 years here. Okay, so I value the option value here is $1.86. That's how we value this option. Now I'm going to go to see what the market is valuing this option at, and that is the Coca-Cola January 19th. That's a Friday, 2024 expiration date 50 put, and they're probably going to value it higher because the volatility the market's expecting is a lot higher. So let's click here to go to that directly. Okay, so again, if you're on the summary page for any stock, you can select options. Then if there's data here, it means you can transact options. If the stock doesn't trade much, there's probably not going to be options, or if it's a new IPO, not yet. We'll select here the expiration date, and it's going to be a put. And so down here, the 50, okay, the 50 is being valued, whoa, much higher than what I expected. And the reason is because the market's implied volatility, the market is expecting 24%. Okay, that's a lot higher volatility than the historical data is implying. And usually the implied volatility is a little bit too high, and we can talk about that if you want to, which is why option sellers make more money than options buyer. So let's go and plug that in here to my spreadsheet, 24% right here. So we'll hard code that in instead. This is the implied volatility. And we'll scroll down here and we'll get the proxy, we'll get the price of this option. Whoops, hold on a second, scroll down here. Here we go. So it's around $2.70, right? And so I think that this option is probably a little bit overvalued right here. Now, in terms of what does that mean with this option, it basically means that if the price of Coca-Cola goes down below 48 and change, then I'll make money. And the reason I say that below instead of just below 50 is because I had to pay $2 and change for that option. So what's the most amount of money we can make in this option? And by the way, when you buy options, they're always in lots of 100. So if I were to buy this option here, I wouldn't pay $3.10. I would pay $310. Okay, they're always in lots of 100. So if I buy an options contract, meaning 100 of them, the most I can make is if Coke goes to 0. But if Coke goes up, the most I can lose, because I paid in my hypothetical model here $2.68, the most I can lose is 268 bucks. So if Coke goes up to 100 bucks, highly unlikely, but the most I lose is 268 bucks. If it goes up to 1,000 bucks, same thing. That's the most I'll lose. If it goes to 50 bucks, I'm still losing a bit of money, right? If it goes to 48 bucks, I'm still losing a bit until it goes below 50 minus 2.68. So around 46, 47 or so, I'm starting to make money. And so graphically, we can see here that we make money. And let me get a little bit more real estate here by minimizing all of this here. Okay. Graphically, we can see, please update sheet. Where's the update here? Okay, let me undo that. It's always harder when I'm doing these live demos. But graphically, we can see, we can see that we make the most amount of money if Coke goes to 0, which is down here. Okay, and let me actually hide this. Might be easier. Okay, good. Goes to 0. Okay, and then I created here reports as well. So if you clicked here, you actually can create a report, and you can print it out, or what you can do is you can email it to, I don't know, people you're interviewing with. So you can put your name, email, and phone number here, and that will be on the bottom of this one-page report. So let me print this report here. I'll just print it to PDF to save paper. And I've got 35 different option strategies, like I'm going to show you right here. So this here, and I love one-page reports, right? So this one-pager explains everything about this option. And again, I have over 30 different option strategies here as well. Here's the ticker. It explains more about it, maximum profit and loss, Greek statistics analysis, and other stuff below that. If you want, I can talk about some of the more advanced stuff as well, like the Greek formulas you use to value options or to analyze them, etc. I can talk about historical versus implied volatility as well, if you want me to. It's something people usually have a lot of questions about.